Welcome everyone to BDO's webinar designed for professional services firms. For those who don't know me, my name is Louis Keeping, and I'm a tax director focused on advising the professional services firms with over 18 years experience, and I've put together the webinar series for the past 10 years. I generally work with a broad range of professional services firms, assisting on various matters, varying from compliance, reserving, international expansion, restructures, anything to do with the PS sector really. For today's webinar, we're providing an update on the latest VAT issues that are affecting professional services firms. And topics that we're covering include e-invoicing. I've spoken to a number of firms around the issues that's causing them, case law updates and implications for the sector, policy and guidance updates. So for those of you who don't already know, BDO is the world's 5th largest accounting network, providing auditing, advisory and taxation services in over 165 countries. We've been long-standing advisors to the sector, and our national professional services team is one of the largest dedicated sector teams within a UK accountancy firm. So through our strong sector focus, we work with a full range of clients, and that ranges from boutique firms through to large international businesses, which include partnerships, privately owned corporates, listed and private equity backed businesses. So our speaker today is Ishvinder Bedi. Ish is director in the VAT team with a focus on professional services, and I'm sure a number of the audience will have worked with Ish before. So Ish spends his time supporting professional services firms on improving VAT controls and processes, VAT determination and recovery, property and land related services, application of disbursement rules, and compliance with making tax digital, just to name a few. So as always, we're running this webinar live and encourage you to ask questions using the Q&A feature, which is at the top of your screen. We'll pick up as many of these questions as we can at the end of the webinar or during the webinar. If time doesn't permit, we'll come back to you after this session. We will finish within the hour and share with you the slides and a link to the recording in the coming days. So over to you, Ish.
Thank you very much, Louis. Next slide, please. Great. So the first thing that we wanted to bring on the agenda today was e-invoicing. So obviously there's been a lot of discussion, as Louis already mentioned, around e-invoicing, particularly in the EU, where EU member states have been implementing their own rules. But we've now had confirmation that the UK is going to be looking at this themselves. So an e-invoicing consultation was released on the 13th of February 2024, 25, sorry, I should say, and was closed on the 7th of May. Now, in relation to this, it is worth thinking about the kind of key drivers here. So effectively, this is not just a HMRC consultation, it's actually in conjunction with the Department for Business and Trade. And it seems to be in line with the current government's push around efficiency, growth, etc. So with that, there's kind of some key tenets that we'll be raising and discussing as part of this update. The point I wanted to pick up, though, is some wider considerations, which I'm sure a number of you are already dealing with, which is really the international piece around the invoicing digital reporting requirements. So as you can imagine, international businesses, particularly if they are in Europe, in South America, will be dealing with the invoicing quite a lot and digital reporting. And so there's a number of points that need to be thought about here, primarily around your own data, around your ERP systems and you know the capabilities, whether they're going to be fit for purpose in dealing with the invoicing, and your own data. And then on top of that, what types of solutions you potentially may need. So as we've seen, there's lots of different domestic regimes internationally which you then need to think about in terms of timelines to comply with those requirements. There are also, then we've got VAT in Digital Age, which is looking at harmonizing the various requirements around the EU. So currently, for example, we have different EU member states introducing their own domestic regimes for e-invoicing and digital reporting requirements. As part of the agreement that was reached in March 2025 on VAT in Digital Age, a number of these countries will operate their own domestic regimes for a period of time up until the point where they do have to harmonize. So from July 2030, transaction reporting requirements like EC sales list should disappear, and it will be replaced with EU with an EU-wide digital reporting requirement framework, as well as e-invoicing framework for pan-European cross-border trade. Domestic regimes will then need to harmonize with the EU standard, and when that happens will ultimately depend on when an EU member state has introduced their own domestic regime. So if they had a domestic regime already prior to 1 Jan 2024, they will have until 2035 to harmonize with the domestic regime with the EU. And if they had implemented e-invoicing digital reporting requirements post Jan 2024, they will have till July 2030 to harmonize. So basically, that was a concession that allow certain countries that had already implemented and invested quite heavily in digital reporting requirements and e-invoicing to basically maximize their returns on those investments first before harmonizing into a different standard. Next slide, please. So with all that in mind, obviously there is a lot of compliance that needs to be thought about across the EU and overseas, and so there is a step that needs to be thought about more generally around how you do comply with those, and the roadmap and timelines that you have to comply with those various models. Now in the UK, the consultation is really focused on a number of key areas, but again, it's been focused on trying to meet a number of objectives. Those are around increased adoption. So right now, HMRC accept that there's a low take-up of e-invoicing in the UK. We have e-invoicing already through EDI or through electronic invoicing, PDF invoicing, etc., but nothing with necessary requirements to have structured data to allow for the automated processing of these invoices. So they're now looking at what they can do to help increase adoption to basically improve kind of business efficiency. The other tenet that they're thinking about is business facilitation. So again, thinking about the cost it takes to and the time it takes to process invoices, whether that can be reduced as a result of e-invoicing. They're also thinking about the time it takes to have invoices then processed, and whether actually that potentially improves cash flow, and mention a number of examples where the time to pay had effectively reduced significantly in a number of countries as a result of the implementation of e-invoicing. They're also looking at reducing fraud and improving data security. So, for example, having direct feeds of data between suppliers and customers should hopefully reduce the risk of fraudulent transactions or fraudulent invoices being issued and being paid to the wrong accounts. And they're looking at simplifying tax compliance. So, for example, can you use e-invoicing and digital reporting requirements to effectively facilitate or pre-populate VAT returns, or even if done correctly, completely remove the requirement for VAT returns altogether? And then there's also the environmental impact that they're looking at. So obviously, the reduction of paper for issuing invoices. Now, those are the objectives. They also focused on a number of key areas that they wanted to look at. So one is having a common standard. So in terms of having a common standard, they've asked questions around what they think should be included in the common standard in terms of data requirements. They also wanted to ask what seems to work well with other different regimes which has a common standard themselves, and also whether a common standard could potentially increase adoption, which I think would likely be the case if there was just one type of regime, one type of standard that needed to be met. Most likely, if everyone's going to be operating the same model, same standard, then that would likely increase adoption. They also wanted to look at whether you could have a voluntary scheme or mandated scheme. And interestingly, they initially focus on basically how the government could increase adoption under a voluntary model, potentially suggesting that that might be their potential aim or intention initially. They do also then ask for feedback on the kind of issues that have been faced by facing a mandatory model, and if there's any sort of barriers and timelines that need to be thought about if they were to actually introduce a mandatory model as well. So again, thinking very much with business in mind as to what needs to be thought about and what needs and making sure that businesses are consulted and have the appropriate amount of time to implement anything that comes in. Then moving on to centralized and decentralized models. So a centralized model will be a situation where e-invoicing would be effectively directed through a tax authority. So a sales invoice sent to a tax authority, it could be reviewed by the tax authority, most likely on an automated basis, and then issued to the buyer. And then that gives some sort of control around loss of tax and potential fraud from their part. The decentralized model will obviously remove HMRC or a tax authority from that, so there would be a direct feed between suppliers and customers. And interestingly, in terms of the questions being raised by HMRC in their consultation, they have really focused on whether it would be correct for the government to focus on a decentralized model rather than centralized model, kind of suggesting that what their initial thinking is in this area. But on top of that, they have asked about questions around understanding whether or how a decentralized model would potentially impact on their business. Then next slide, please. So the other point that I found interesting in terms of consultation is that they also make a reference to real-time data reporting or real-time information, RTI. Obviously, so it again suggesting their thinking around whether the scope for e-invoicing can be expanded or can be utilized to push for digital reporting or real-time reporting. Now, in terms of their questions in this area, they're also asking whether, for people's views on RTI and e-invoicing for B2B and B2G, so business to government transactions. They've also asked if there's scope for additional support service to be provided to business to help them adopt real-time reporting or e-invoicing. So, for example, pre-populated VAT returns. Now, more generally, they then ask a wider question around, of all the proposed models and of all the suggestions that could be raised, what do you think would probably meet policy objectives best? So again, thinking about the key tenets that they're focusing on, business efficiency, reducing fraud, improving efficiency around compliance, it does seem to be focused very much on improving and helping business rather than a new standard of compliance to ensure, to manage tax compliance rather than anything else.
And Ish, just pausing there quickly, what do you consider to be the specific issues with e-invoicing that's going to face the professional services sector? Have you got a feel for that?
Yeah, So I think so far from the discussions that I've had so far, it's been largely the global scale of it. So obviously, particularly with international law firms, international firms in general, they can have different instances of ERP systems across different territories, or they can operate the same sort of instance of an ERP system. The question then comes around the different regimes that they need to comply with. So, like I mentioned, with the various domestic regimes, and then the potential harmonization of across EU rules, and there being different timelines for that depending on when the country implemented their own domestic regime. They're going to have their own domestic regimes to think about. They're going to have then harmonization with the EU rules, so they need to have one eye on the future as to when some of these changes are coming. And so really, strategically, there needs to be a discussion around how is a business going to be managing this. Is there a solution directly in the ERP system that can manage this? Chances are probably not. And so actually you need a third-party solution. The question there then is, how does that third-party solution work with your ERP data? What data do you need? What data do you have? Can you get the reports out appropriately? If you start then escalating that and then multiplying that by the various different domestic and international regimes that you then have to deal with, and then have to then obviously conform with a different standard later down the line, it starts becoming quite a complex thing to manage. And then that raises the other question that we've been dealing with, which is who should be picking this up? So more often than not, obviously I'm speaking to VAT specialists and tax specialists, but this is ultimately a fundamental change in the way the business is operating a key process, right? It's your invoice processing, either on sales and on your purchases. That in itself then means you have to think about how that's going to be operating more widely. It's not just a tax matter anymore. It's a wider business matter. So for example, if you have a shared service center operating on a global scale, dealing with all processing of invoices, how are you going to ensure that that shared service center is going to be compliant with all the different regimes that they will need to think about, either on the purchase or sales side? So yeah, I think something like this needs buy-in, not just from tax. It's a wider finance matter as well, and it's a wider business operational matter. But that is also, I think, a key thing that needs to be thought about for law firms, like who holds the pen on this.
Absolutely.
Yeah. So moving on, next slide, please. So then moving on to the case law update. So there's various matters that I want to bring up. The first is Hastings Insurance Services Limited, which is a first-tier tribunal decision for now. So obviously only relevant for now to HMRC and Hastings. Now, for background, Hastings basically provided insurance brokerage services to UK private car, van, motorbike, and home markets. The way that this worked is that they provided brokerage to, or brokering services, I should say, to a insurer based in Gibraltar called Advantage Insurance. That insurance company provided insurance contracts to the individuals individuals in the UK. So from Hastings' perspective, they considered that they were only providing an insurance intermediary service or broking service to a company based in Gibraltar. Now, the reason why that's important is from a VAT perspective. If you're providing, or if you were providing insurance intermediary, or financial services to a non-EU individual or entity at the time, then it would be effectively treated as a VAT exempt supply, but you would be allowed your VAT recovery on the basis that the supplies in this sales in question qualified as what we call specified supplies, which it looks like HIS used to Advantage to basically maximize VAT recovery in the UK. In 2018, HMRC challenged that, and it went to the courts. HMRC arguing that Advantage was actually based in the UK, but they lost. As a result of that case, HMRC changed the rules around specified supplies and effectively blocked situations where insurance intermediary services were provided to an insurer outside the EU, but the insurer was providing services to customers in the UK, so effectively blocking that offshore loop. Hastings, however, challenged that and argued that they should be entitled to £16 million of input tax on the basis that HMRC's changes were incompatible with EU law at the time, and fundamentally that they should still rely on the direct effect of EU law, and so should be able to get their VAT, because actually the specified supplies treatment was effectively enshrined in EU law as well. Next slide. So the first tier tribunal actually found in favor of Hastings and found that actually the customer was Advantage Insurance, not the UK end customer. So HMRC tried to argue that when you look at the EU rule, even if you could try to rely on EU law, the EU law notes that you have to consider who the customer is and where they're located. And for HMRC, they considered that the customer was the end recipient of the insurance, i.e. the entity in the UK. But the tribunal found that Article 169C was clear, and it was just talking about where the customer is established from Hastings' perspective. Now, the customer wasn't specifically defined, and so it needed its ordinary meaning. And so you had to then take that to be the location of the next person in the supply chain, as opposed to the actual end user. So in this case, Hastings' customer had to be Advantage Insurance. It also found that the amounts didn't really concern, or suggest it wasn't necessarily avoidance, because taxable persons are allowed to set up their structures in a way that's appropriate for their economic activities. So again, effectively another loss for HMRC in this area. Next slide. Now, what's the impact? Well, like I mentioned, it's a first-tier tribunal, so it's not legally binding at this point, but it's worth thinking about if there's any sort of insurance intermediary service being provided or broking service being provided, that if you blocked VAT in that as a result of the change in the rules in 2019, whether you should be considering protective claims. It also gives a bit more guidance around the applicability of EU law pre and post Brexit. So pre-Brexit, we had the direct effect of EU law. So if something hadn't been implemented in UK law at the time, but we would want to rely on it because it would work in our favour, we as taxpayers were allowed to use the direct effect of EU law. However, tax authorities weren't necessarily able to. So that was still enshrined pre-Brexit. Now, post-Brexit, you could still rely on direct effect up to a certain point because it was still recognised within the EU Withdrawal Act. Post 1 Jan 2024, however, there's a wider question that needs to be thought about. And then that brings up on issues around conforming construction and Mar leasing principle, given that the direct effect has been removed, or the ability to rely on the direct effect of EU law has been completely removed from 1 Jan 2024. It also has a useful discussion around who your customer is. So obviously looking at the ordinary definition of your customer and who the next party in the supply chain is. And that is also important for place of supply determination. So we've had key pieces of key cases around air tours, for example, around your evidence of who the recipient of your supply is, but also this I think is quite helpful to then consider who your customer is potentially. Yep. Next slide, please. So moving on, so we're picking up on some CJEU cases that we consider are of importance or relevance. So for Dryketor, there is effectively a Polish VAT registered company that helped provide transport services and would enter into contracts with local authority to provide subsidized transport. Now, the revenue that it would generate from ticket sales and other means would not actually cover the cost of the transport services provided. So the local authorities would pay compensation to cover those losses without affecting any sort of ticket pricing. That compensation was effectively a flat rate charge based on miles driven, kilometers driven, etc. And so it wasn't actually linked to specific tickets sold or individuals utilizing transport services. Now, the company applied for an advance ruling in Poland to ask whether that compensation payment from the local authority would actually be taxable turnover of VAT and should be factored in. Now, the company argued that that compensation wasn't taxable revenue because actually it wouldn't have an impact on the price of the transport provided. But the Polish tax authorities effectively disagreed with that and argued that the amounts paid would have a direct effect on the price because ultimately, without those compensation payments for them to provide this transport service, the price would have to increase. Now, upon appeal, the ruling was actually set aside, which was then appealed again to the Supreme Court, and then that was referred to the CJEU to consider whether the compensation payments as those described could potentially be outside the scope or be seen as consideration for a supply. Next slide, please. Now, the Advocate General effectively distinguished between compensation and subsidies where there was a direct link between the price of the services and the payment. Then in that situation, the compensation would effectively be taxable. But if it was a general subsidy and not tied to a specific transaction, then it wouldn't be taxable. So in this situation, if there was a subsidy being provided, it would need to provide a specific benefit to the provider of the subsidy in return for that payment. And in that situation, then there could be a supply for consideration and therefore a taxable supply. So in this case, the AG found that there wasn't a sufficient link between the payments made and services actually given because you couldn't link the compensation payment to a specific supply. The CJEU also then found, well, actually, if you look at it, it is a flat rate payment, and they specifically say, well, this is for the benefit to all, and you wouldn't be able to link any single payment to a clearly identifiable individual or individual supply. And so from their perspective, they had to treat it as outside the scope of VAT. Now, what does that mean? Well, there's a clear link that must be identifiable. And that's going to be really important then to understand whether something can be qualified as compensation outside the scope and could be, or alternatively could be taxable. We also have, Revenue and Customs Brief 0222, which summarized HMRC's updated position on compensation payments. So a couple of years ago, HMRC announced a complete change around their VAT treatment of compensation, and issued new guidance. It had to go through, it went through a certain amount of pushback from industry, and then they released an updated guidance note that we have now, which has a large focus on reciprocity. But ultimately, case-by-case analysis really is needed on any sort of compensation payments, and this case also seems to align to that view. So understanding what you're receiving and the VAT treatment is going to be very important to make sure you don't inadvertently trigger an exposure by getting the VAT treatment wrong.
I know you just touched on it there, but what are the key kind of issues that PS firms need to think about if they're either receiving or paying compensation payments?
Yeah, so the key there is to consider HMRC's updated guidance and to review it. So particularly when there's compensation payments, there can be a large amount. There can be large amounts at stake. Now there's potential risk, obviously, if you are receiving large amounts that's outside the scope, and you're not charging VAT, not declaring that to HMRC, for example, there's a risk there. Likewise, if that's been charged to you on a and you look to recover that, and that was done incorrectly, there's a risk to you as the from the other side around recovering VAT incorrectly. So it's really worth, if you're dealing with any sort of compensation payment, to think about, if you're receiving or supplying, reviewing the guidance, but also putting in the appropriate protections in the contract to basically make sure, in the situation where you take a view on the VAT treatment and you disagree, that you're not going to be at a loss here. So that's going to be absolutely fundamental, because it's you do have to consider it on a case-by-case basis now. The other piece is, if you're looking at compensation payments or outside the scope payments that don't fall within the VAT scope, if you're doing that regularly enough and receiving significant sums, there is a potential question around whether you are effectively seen as partially non-business, because compensation payments aren't seen as business income.
Yeah.
And that raises a wider issue around your VAT recovery, because you can only recover VAT to the extent that you are seen to be in business. Right. So to take a worst case scenario, say you have 50% taxable revenue from services, 50% of revenue from seen as outside the scope, might be penalty charges or otherwise. HMRC might argue, well, you're then 50% recoverable because 50% of your business relates to or operations relate to non-business activity.
Yeah.
So there is a wider piece that needs to be thought about. So it's not always necessarily the best thing to treat something as outside the scope. But again, case by case basis that is needed here.
Yeah, makes sense.
Yep. Next slide, please. So the next case that we wanted to pick up on was Archimet tower cranes, which sounds like it might be of limited application to professional services if we're dealing with cranes, but there is an impact here in regards to transfer pricing, because VAT and transfer pricing hasn't really been considered or tested significantly in cases. So in this situation, we have Archimet Belgium, basically a parent of Archimet Romania, was providing services to Archimet Romania. It could be general ad hoc support, but also support around identifying and negotiating leases or purchases of cranes. And as part of a transfer pricing study, determined that the company should basically only maintain, the Romanian company should operate a margin of minus 0.71% to 2.74%. Now, over 3 years, 3 invoices were issued by Archimet Belgium to reduce Romania's operating margin. The reverse charge was applied on the first 2 invoices, but the third one was treated as disregarded or outside the scope on the basis that it was just a pure transfer pricing adjustment. So in that situation, they're effectively arguing that a transfer pricing adjustment was being made. There was just a flow of funds to reduce the margin, but there was no supply being made, and therefore it wasn't subject to or wasn't within the scope of VAT. Now, the Romanian tax authorities refused that treatment and actually looked to refuse input tax recovery under the reverse charge on invoices related to transfer pricing adjustments. and they argued that the business couldn't substantiate whether there was a supply or whether those supplies were even directly necessary for Romania to make taxable supplies due to a lack of supporting documentation. So questions were again referred to CJU. One, looking at whether there was in fact a supply, and two, the extent to which additional documentation would be required to justify if a service was, or whether there was a service or a taxable sale, and whether those can be linked to the to an individual supply or to the business as a whole. Next slide, please. Now, the Advocate General suggested that when looking at transfer pricing and VAT, again, this needs to be considered on a case-by-case basis. So in this case, there was a clear contract for services between the two parties, where both parties agreed to supply services to each other, and the contract was governed by and confirmed the amount of remuneration payable in either direction. As a result, I think they felt that VAT would be due in this situation. The tax authorities are allowed to request additional documentation to justify the applicability or recovery of VAT, as long as those documents requested are proportionate and can prove that there is in fact a supply that has been used by the business for its taxable activity. Now, in terms of the impact, like I say, it's just an AGO, so it's not. It's just an opinion. We're waiting for the final decision, but the AGO does seem to align with HMRC's approach that you need to look at this on a case-by-case basis. We have got an internal manual within HMRC's website, which refers to transfer pricing adjustments potentially being outside the scope, but we also have references to saying, well, if these transfer pricing adjustments are actually linked to a supply of services, or actually linked to adjusting the value of a supply of services or goods, that could also impact on the VAT treatment that you're applying. So again, you need to then think about what this potentially means. More practically, it also highlights the need to make sure that you've got good documentation in place to be able to justify, one, if you're making the charge, that's a business activity and that you can justify your VAT recovery, but also if you're receiving those transfer pricing adjustments, that you're applying VAT correctly and that's linked to your business as a whole. More practically, we have seen certain situations where holding companies or other kind of group support companies are relying on transfer pricing adjustments and transfer pricing policies agreements to justify VAT recovery. Again, worth thinking about what documentation you have. Is it up to date? Does it reflect on your business activity sufficiently to be able to justify VAT recovery or not? It's something that probably just need to be thought about more generally, given that this is now an area that obviously has got a bit more attention. Next slide, please. Yeah. So the next case now is Lakov. So this is again another AGO regarding pro bono treatment of pro bono legal services. So in this situation, basically lawyers provided legal services that were free of charge, but in this case it was for a civil matter. But upon winning, the business, the law firm looked to get awarded the lawyer's fee from the losing party. The question that arose was whether that award of legal fees would be subject to VAT, i.e. is there a provision of legal services being provided and subject to VAT, or is it effectively compensatory in nature and therefore outside the scope? So the question asked was whether basically the legal services could be potentially seen as a transaction subject to VAT. Now, the Advocate General in this case said, well, look, even if legal services are initially provided free of charge to a client, they can still be regarded as a taxable transaction if there's a statutory fee or statutory requirement to pay their legal fees by the unsuccessful opposing party. So in the other party in the legal dispute. They also noted that payment doesn't have to come directly from the client for the service to be taxable. And that's a point that's been considered widely in the UK. We refer to it as third-party consideration. So that in itself isn't new. They also make the same points that we've raised before around identifying if there's a payment for a supply by identifying if there's a direct link between the service being provided and payment being made. So in this case, there's a legal obligation for the losing party to pay the lawyer's fees. And the fact that there was some uncertainty around the fee amount at the time the service was provided doesn't negate the taxable nature of the transaction. Ultimately, legal services were provided to the individual, and effectively the losing party had to pay for them. In that situation, there was still a supply of services, of a supply of legal services to the individual, and therefore VAT was still applicable. Moving on. So the final case that I wanted to pick up on was a case of Chris Poulton. So again, this is initially sounds like it may not necessarily be immediately relevant because it's talking about a DIY scheme. A DIY scheme is a situation where you build your own house and then look to claim VAT from HMRC. But again, it will have a wider impact around the interpretation of UK VAT law post-Brexit. So in this situation, Chris looked to submit a VAT refund for a house that he built. Most of it was refunded. He then subsequently inquired about 10K of VAT that he then said he wanted to try and how he could basically recover that VAT based on the fact that the suppliers were in liquidation. HMRC treated that inquiry as an additional DIY claim and refused the claim on the basis saying that the supply should have been zero rated, and so a claim for a refund should have been directed to the supplier, not to HMRC. Chris then subsequently appealed, and HMRC looked to strike that appeal out. Now, in his appeal, Chris argued that Reemtsma principles would apply, and this is basically a CJU decision that arose where in situations where it would be impossible or excessively difficult to claim a repayment from a supplier, that claim could be made against the tax authority directly. HMRC argued post-Brexit that the rights held under Reemtsma no longer exist, and that the first tier tribunal didn't actually have the jurisdiction to consider this in the first place, and so the appeal had to be struck out. Now, the first tier tribunal, however, said that under Section 28 of the Finance Act 2024, when interpreting VAT legislation, the general principles of EU law are retained, including the Mar leasing principle, which I will come up to shortly. And this is conforming construction. Further, they found that it did have jurisdiction to at least hear the claim, and so the appeal wasn't struck out. So that means the appeal will be going to a substantive hearing, which means there will be a case now discussing the extent to which EU law and case law is relevant when considering UK VAT matters. Now, this is obviously an interesting case because it's really going to set the tone as to how that will apply going forward. Now, we have two different things to think about at the moment. So we have the direct effect of EU law, which was removed post-Brexit, and that was discussed earlier, as we mentioned, as part of Hastings. But we also have conforming construction, or the Mar leasing principle. And the Mar leasing principle is effectively a situation where national courts have to interpret UK law as far as possible in light of the wording and purpose of the VAT directive in order to actually achieve the result intended by the directive. Now, that is still required. So whilst we can't rely on the direct effect of EU law, we can potentially, in certain instances, rely on conforming construction to basically help us interpret UK law. So there is a key difference there. The key then is considering to what extent that applies. Now, we know based on the Finance Act 2024, and we also know based on HMRC's own guidance, which they released in Business Brief 0424, that they do consider that the Mar leasing principle is still in effect. So now we'll have to see, obviously, how far this will go and to what extent HMRC will try to limit rights and potential claims that were initially held under EU law. Yep. Next slide, please. So now moving on to policy and guidance updates. Next slide. So for partially exempt businesses, HMRC have substantially rewritten their direct attribution and apportionment guidance for partially exempt businesses. The main reason for this is to reflect on changes to case law. So, for example, the direct attribution guidance now refers to the case of Volkswagen Financial Services. It also refers to Royal Opera House and Mayflower Theatre, which all looked at attribution of costs in different ways. So in example with VWFS, it was a partially exempt business that provided asset finance. It sold a vehicle at cost, generated exempt financing, but its whole business was funded by the exempt financing element. The fact that it was wholly funded from the exempt element of its business did not change the fact that actually its costs could be attributed to both taxable and exempt supplies. So again, key consideration needs to be thought about if you're partially exempt to make sure you're attributing costs or treating costs as residual correctly, particularly if it can be linked to both. In terms of the Royal Opera House and Mayflower Theatre, these were two cases that looked to attribute or to treat costs as residual or production costs as residual on the basis that they were linked or arguably linked to catering or the sale of programs. Both were thrown out of court and both lost because the actual production costs were obviously linked more directly to ticket sales than anything else. So again, they've updated the guidance to give you a bit more of a bit more detail around how you should be attributing costs and whether there is a direct immediate link. So that again needs to be thought about in a bit more detail. Next slide, please. Now, just finally picking up on the partial exemption piece as well, given that there's been a substantial rewrite of the guidance, I should also note that it's worth thinking about reviewing that if you're partially exempt and considering whether any of the updates or changes are relevant to your business. And if not, why not? So thinking with a controls and processes piece hat on, with an SAO hat on, as well as notification of uncertain tax treatments, it's worth making sure that you can document your acknowledgement of that updated guidance and whether it's relevant or not. There's also updated record manuals on trader records. So in terms of what a valid VAT invoice should be, much of that has been moved to the guidelines for good compliance, as well as some minor pieces around intra-EU supplies for Northern Irish businesses, and then easements for banks, and less detailed VAT invoices for retailers. But again, I think the key point for professional services firms here is point one. So i.e. valid VAT invoices and the guidelines for good compliance, ensuring that you make sure your sales invoices are valid VAT invoices and that your purchase invoices are valid VAT invoices to allow for VAT recovery. All right, next slide, please. Now, the next development that we are picking up on is the spring statement. So there have been two key developments that we're aware of. One is the announcement that the capital goods scheme threshold will be increased to 600k from 250k, which is interesting because it's been 250k for a long time. And it plans to remove computers from the scheme. So for background, the capital goods scheme is an arrangement where if you have a large capital expenditure on certain items, i.e. property or property-related costs, a single piece of IT equipment, or a yacht, aircraft, etc., then you have to monitor your VAT recovery over the course of a longer period of time. So with property, it has to be 10 years. For IT equipment or yachts and aircraft, it is up to 5 years. Now, barely anyone ever had to fall under the capital goods scheme for IT equipment, so that sounds like it's going to be removed. The increase in the capital goods scheme threshold for property is going to be interesting as well, because there is actually a lot of anti-avoidance that relies on capital goods scheme rules. And so if you're changing the threshold, the government needs to consider what the impact will be on wider anti-avoidance. Now, we know the change has been announced, but we don't know when that's coming. So it's something that needs to be thought about in a bit more detail. But obviously, when more information is presented, then we will be able to provide a bit more detail on the impact of that. Next slide, please. The other point that was mentioned in the spring statement was a change to the penalty rates for late payments. So as you may recall, previously, a few years ago, the default surcharge VAT penalty regime for late filing and late payments was removed and scrapped for two different penalty regimes, one for late filing, which was a points-based scheme, and then one for late payments, which arguably was a lot more favorable to taxpayers. So under the new penalty regime for late payments, if you paid within 0 to 15 days of the deadline, there wouldn't be a penalty. But then there would be a 2% penalty if you paid within 15 to 30 days, another 2% penalty if you paid after 30 days, and then an annual pro rata penalty of 4% after 31 days. Now that's been uplifted from 1 April 2025 because actually they felt like maybe it was too favorable for taxpayers. So the initial base rates of 2% have increased to 3%, and then the pro rata penalty has increased from 4% to 10%. So that's a significant increase. Obviously, if you're in a situation where you are actually struggling to pay, or you may not pay, it's worth speaking to HMRC first, looking to agree a time to pay arrangement. You know, ideally, you wouldn't want to be falling within these late payment penalties. If a discussion can be had with HMRC in advance. Yeah. Next slide, please. So the final thing that I wanted to pick up on was the new rules around virtual events, which was implemented from the 1st of Jan 2025. So previously, the UK and EU rules around virtual events were technically aligned, but it wasn't really, it was aligned but accidentally, really, because it hadn't really been considered directly. So under the previous rules in the EU, if you were live streaming or hosting a virtual event, the place of supply was effectively where the activity took place. So effectively where you're actually running the event. Now, because most suppliers ran those virtual events in their home territory, place supply tends to be where the supply was based. And this is obviously in a situation where we're dealing with events and kind of effectively tickets to events. But B2B services were supplied under the basic rule where the recipient belonged and therefore subject to reverse charge. Now, the question then arose as to whether that was correct, and the EU looked to change their rules around live streaming and virtual events. So effectively, from 1 Jan 2025, it's more treated like an ESS or an electronically supplied service, and therefore is treated as taking place where the customer is located. So in that situation, say for example, it's a German business hosting a virtual event that then in which French customers, French individuals only join, then it would be subject to French VAT after 1 Jan 2025. Pre-Jan 2025, it was subject to German VAT. So that's the key update. The problem is that the UK hasn't officially updated its position either. So next slide, please. So to take that example, the UK rules technically remain unchanged. So we consider there's basically a risk of double taxation or no tax at all. So to take these two examples, a UK company was to host a webinar for EU individuals. Well, under UK VAT law, place of supply is effectively the UK because it's where the supplier is located or where the event is located, which is the UK, therefore UK VAT. But at the same time, if you have EU-based individuals dialing into this, joining the online webinar, paid for online webinar, then that's going to be due based on where the customers are located. So there's a risk of double taxation. Alternatively, if there's an EU business looking to host a webinar to UK individuals, well then no EU VAT applicable because it's treated as taking place where the customer is located, in this case in the UK, but also no UK VAT, also no EU VAT, no UK VAT would be applicable because it would be treated as taking place where the event is managed, which would be in the EU. So it's effectively it leads to either double taxation or non-taxation. We have representations have been made to HMRC about this point, but they've noticed, or they have confirmed, things like educational webinars might potentially be treated in the same way as the EU rules, but more wider impact around live streaming and other types of events, we would have to see. So the reason why I bring this up is obviously post-COVID, a lot more events being held online. Obviously, this has always been an online event anyway. But if you are hosting an online event that is paid for, you need to be thinking about the rules around virtual events and the applicability of VAT based on the customer and where they're located, but also in terms of your current location too, and what that potentially means from both regimes. And that is the end of our presentation.
Thanks, that's really interesting. Lots of updates around case law, which is useful to kind of see and useful applying it to the PS sector and how the firms might want to think about that. One question we've had is, given the recent HMRC guidelines for compliance with VAT processes, how are you helping PS firms manage and mitigate the position?
Yeah, so it's interesting. We've seen not just with the guidelines for compliance, we've also seen a lot of HMRC activity in this area. So a number of inspections, BR plus reviews, all focusing on the guidelines for compliance, and various elements of it. So the VAT return process, the procure to pay, et cetera, the staff expenses processes. What we've been suggesting and what we have been helping businesses do is understand what the guidelines for compliance says, both in terms of what are the core fundamental kind of objectives of the guidelines for compliance. What are they trying to achieve? And what are the suggestions that are good practice as from HMRC? Again, they note that those guidelines aren't meant to be a be all and end all or an exhaustive list of everything you're meant to be doing. You have to consider what the guidelines say and what is appropriate for your business to make sure it's, that you have the appropriate control framework for your business. So we've been helping business to understand what those guidelines say, and review their own controls and processes to understand where the potential weaknesses lie or where there might be inconsistencies with what HMRC considers to be good practice, and then considering the extent to which those current those guidelines for compliance are workable in line with the business at hand. So, like I say, not everything that HMRC suggests is going to be appropriate. They understand that too. So really then it's a question of understanding what good looks like, what you're currently doing, is there a gap? And if there is a gap, is that justifiable or not?
And with that in mind, are you seeing a bit more of a shift towards technological solutions for VAT reporting?
Yes, I'm also seeing a lot more discussion being held by HMRC around the technical solutions that are being used. So, and so to take an example again, the guidelines for compliance note that they prefer automated rather than manual checks. Yeah. We also have some additional guidance from HMRC in regards to making tax digital, like a compliance note, where they say, well, if your MTD solutions or if your ERP solutions have some automated testing in there, you should be using it. And actually, in the compliance note, they say you have to use it, but there is no legal obligation to under legislation. But the guidance seems to suggest that they think you have an obligation to use it. So there is a lot around that. We're seeing HMRC ask a lot more questions around data and process and control now as well. So I think it's definitely something that needs to be thought about and kind of improved on, because if it's not raised now, chances are it'll be raised as part of the next inspection.
Yeah, absolutely. Okay. Thank you very much. So I think that's all the questions that we've had today. So I'll give you a bit of time back in your day. So thank you to Ish for joining us today. We will circulate the slides and recording this webinar in the coming days. Our next webinar that we're hosting is on the 4th of September, which provides a US tax update for professional services firms. Very topical at the moment, given what's happening in the US, and we'll be joined by our professional services experts from BDO USA. So a slightly different time for that session, given the time difference that we've got over there. So it'll be mid-afternoon. Invites will come out shortly. Wishing you a lovely day ahead. Many thanks.